Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. It's just after 12 noon Eastern Time. I want to say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, and the Pacific Time Zones. And of course, good evening to those of you who are joining us from across the pond in parts of UK or parts of Europe, and good early morning if you're joining us from parts of Asia or parts of Australia or New Zealand as well. Welcome to today's presentation, a brief discussion on weekly options, using weekly options for your accounts, and brief history as well. And of course, we're going to showcase using the PowerOptions tools to discuss some of the ideas and concepts about weekly options. Now, before we begin, just want to introduce what is PowerOptions. Well, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options in over 23 of the most commonly used option strategies to identify only those positions that match your personal risk-reward tolerance. We do, of course, offer default searches and theme searches for you to use as a stepping stone in each strategy to create your own personal search. After you've identified the position, you can quickly compare the risk versus reward, do further research and analysis on the stock or the option. We also offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions as well. Now, of course, we do offer countless educational articles, help videos, help tutorials, and archived webinars to help you get more familiar with the various option strategies and the tools on the site. Ernie Renner created the PowerOptions tools back in 1997, so we've been in business for almost 20 years. And everyone here on staff, of course, uses these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, for those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at PowerOptions. I've worked with Ernie Renner and the PowerOptions staff since about 2001, 2002. I do handle a lot of the coaching sessions and education. For those of you that are trial members or subscribers to PowerOptions, you know you can register for one of those free coaching sessions at any time. It's just essentially a 35 to 45-minute phone conversation. We'll walk you through the tools on the site and answer any questions that you have. I have co-authored 2 books with Ernie. I have also presented across the country in places like Atlanta, North Carolina, Chicago, and Texas as well for various options education and option strategies. All right, now I'm going to do a very brief introduction here that most of you are probably familiar with, but we want to just kind of review this because it's always important to remember. I get a lot of phone calls from customers and from new options traders and saying, I want to understand weekly options. I've been trading covered calls and credit spreads for about 2 years, but I want to understand weekly options. Well, the key to remember is that weekly options are no different than regular options, regular option strategies, whether you're doing spreads, whether you're doing cash secured naked puts, maybe if you're even just buying options or playing straddles and strangles around an earnings event. There is no difference between the weekly options and standard options. The only difference is a shorter time frame. If you're selling option premium, of course, you're going to have a higher annualized return. If we can sell week by week by week, or every 2 weeks out in time, you're going to see a much higher annualized return. Those of you who are used to doing maybe credit spreads or other premium positions, income generating options positions, know that you get a better annualized return if you sell month by month as opposed to selling the option that's 6 months out in time. The option that's 6 months out in time will not be 6 times the cost. And the weeklies are the same way. The weekly options offer a more flexibility of management. A lot of times we'll have a question come in that says, hey, I bought a stock today and I sold a July call for a $3 premium and the stock gapped up 10%. Now I can't manage it if the only role that I have is buying back and rolling maybe to September or October to roll for a credit. Well, one of the advantages of the weekly options, of course, is that you could roll that to the next week or the next 2 weeks or the next 3 weeks out in time without having to potentially stay in a position for a 6 to 8 month period in the hopes of managing it and recouping your losses. Of course, there's also some cons with that. We'll get to that a little bit later as well. Now, about 1/10 or 1/9 of the optionable securities currently offer weekly options. It's above 400 stocks, indexes, and ETFs that now offer weekly options. Technically, they expire on 4 p.m. on Friday, as opposed to standard options, which technically expire on Saturday, with the exception of VIX options, of course, and some of the SPX options. We'll talk about that in a moment. Very brief history. On October 28, 2005, about 11 years ago, that's when the SPX started offering the weekly options, cash settled just as regular SPX options. In 2006, other indexes were added for the weeklies. And then on June 4th, 2010, the first weeklies on ETFs began to appear, and then shortly afterwards, the four main stocks that offered weekly options at the beginning, Apple, Bank of America, British Petroleum, and Citi, started offering weekly options. Now, originally, of course, we all remember when weekly options came out, the new series was released on Thursday, right before Friday expiration for the next week. So you have to wait till Thursday to look to adjust and manage your positions. Most of the securities that now offer weekly options offer what's known as the continuous weekly series. So you'll see weekly options that are at least 5 to 6 weeks out in time. And that's the way it seems like everything is going now. Basically, all of them offer the options about 5 to 6 weeks in a row, sometimes even more. SPX is subtly different. They do offer Friday options about 6 weeks out in time. They also offer a Wednesday expiration series, and that started back in February of 2016. So when you're looking at an option chain, it is important to see that you'll see a Wednesday series, then a Friday series, then another Wednesday series, then another Friday series, then another Wednesday. Yeah, they're just trying to confuse us personally and you as well. Yeah, that was different from the original weekly offering, and I think the market is just going to stay in this way. I don't know. I looked at CBOE a couple days ago. I don't know if there are any plans for the other indexes to offer these Wednesday expiration cycles along with SPX, and where VIX expires on that Wednesday evening as well. Now, to make things even more complicated, and we'll take a look at this later, a lot of securities that offer the weekly options, of course, offer dollar strike increments or even 50-cent strike increments. Now, that's not necessarily a problem. It gives you more opportunities for management, adjusting, rolling, or trade selection. But at the same time, if I'm in a position, and I've had this before, where I'm in a credit spread of a dollar strike difference and it kind of moved against me, and I'm looking to roll out to a standard expiration, say to June or July, the June or July series might not offer the dollar strike differences. So I may have to roll to a 5-point strike difference or a 3-point strike difference, for example. Let's pause for a minute, and I'm just going to show you that very quickly, some of those examples. Let me just navigate over to the PowerOptions suite of tools here, and I'm just going to pull up a chain on Apple very quickly. Okay, so we're looking here at a small chain for Apple, which is currently at 93.10. And what we see here is that the May 13th series that expires on this Friday does have those 50-cent increments. We have 92.5, 93, 93.5, 94. Gives us a lot of opportunity for different spread positions. So we could choose even a 50-cent strike difference or a $1.50 strike difference. And as we get into the $100 range, they break. Okay, so that's important to note too, is that we have the 50-cent strike increments up to 100, and then it goes to the standard dollar increments. And it'll be the same for the 520. Now, 520 is a standard expiration series. Originally, the May 20th expiration, when it was released in the markets, probably 5 to 6 months ago, only offered 2.5 or 5-point strike differences. 5-point strike differences above 100, and maybe 2.5 below the $100 level. But as we got within 4 or 5 weeks to the May expiration, they added the extra options for the 50-cent strike increments and then the dollar strike instruments over $100 per share. But let's say that I was in a spread, maybe a bull put credit spread. I thought Apple was going to recover. Maybe I did a 95-93 bull put spread for this Friday, and now it's come down and stock's at 93. So I'd have about the full loss of 2 points on that spread. If I wanted to try to roll for a 2-point credit, I know I may have to go out to June or possibly out to July. We see the 6 cycles available, 13th, 20th, 27th, June 3rd, June 10th, June 17th, and June 24th. So those are the current weeklies available. Let's go to July. And here we see, let's go to the medium chain now. We see we're back to square one, aren't we? We have only 2.5 strike differences up to 100, and then we have 5-point strike differences going above $100 per share. In the next 2 to 3 weeks, this will likely open up, and you'll see the 50 strike differences available for July under $100, and the dollar strike differences available above 100 as well. Okay, so that's just a quick example of how this kind of goes as we go further in time. If you look up a series, you look 6 weeks out and say, oh, the dollar strikes or the 50 strike increments aren't there. In a week or two, they probably will be once it gets within 4 to 5 weeks. The standard expirations further out in time will convert to the weekly strike differences for all stocks that offer the weekly options. Okay, let's go back real quick. Now, let's talk about the typical strategies that are used for weekly options. Now, as we just mentioned briefly before, the standard rules of options, since we know that if we sell closer in time, month by month by month, or even week by week by week, we get the higher annualized return. The option that is 6 months out in price and at the same strike price is not going to be 6 times the cost. Okay? So when buying options or long strategies, we do look for further out expirations. If I'm buying a call or buying a put, speculating on a market movement in one direction or the other, I probably want to go at least maybe 2, 3, or 4 months out in time to have a lower annualized cost into the position. Now, that being said, it gives the underlying more time to move in our desired direction, and the cost per day is lower even though the upfront cost is higher. Okay? So in general, what we seem to see from our customers and from the experiments that we've done and the testing that we've done is that using weekly options for buy strategies is not necessarily recommended. Okay? Just buying calls on a weekly basis, looking for the 5-day out or 3-day out expiration, buying puts, combining the two for straddles and strangles, or trying to protect the stock with a married put or protect a short position by buying a long call to create a married call. Using a weekly option, especially if you're planning on being in the position for long term and expecting a higher growth rate or a higher decline rate, it's typically better to buy further out in time. Now, that being said, buying weekly options can be very profitable. Let's just take a look at a recent example. We all know what Apple has done over the past couple months or so, the past month I should say, near the past month, half month. But Apple had earnings on April 27th. Okay, when the earnings were released on the 27th, the stock fell 7 points. It was trading around, it went from about $105 to $97 per share, and then it continued down. Now it's currently at $93.15. On April 25th, the Monday before the earnings event, which was 2 days later, we could have done a weekly strangle. Okay, we offered dollar strike differences, so we had different selections and different opportunities. So we could have bought the 29th April 107 call for about $155. Expires in 4 days, out of the money slightly, and the stock, remember, was around 105. We also could have bought a slightly out of the money put, the April 29th 103 for $155. So our total invested into the weekly strangle would have been $310. Now, if I did a farther out strangle for an earnings play, I might have gone to the July 15th series, but again, didn't offer the dollar strike differences, so we had to use the 5 or 10 points. With the stock at 105, we bought a slightly out of the money 110 call at 245, and then we bought the July 100 put at 275, so we total invested was 520. Now, it's not quite double or triple or quadruple the cost, even though we have as much as 5-6 times the amount of time in the July spread as we did in the April strangle. Okay? However, with the decline, nice little 10% decline or so, close to 10% decline afterwards, down to 93.15, even though we only dropped 7 points, 7% or so at the onset of earnings. But on April 29th, expiration day for our weekly strangle, Apple was trading at 93.74. The 107 call for April 29th, of course, going to have no value. might have gotten 1 cent if we sold to close it or just let it expire. Our 103 put went essentially just to intrinsic value. Okay, so with the stock at 93.74, our 103 put, 925, that would have put us right at about 103 or so. So it went right to intrinsic value. The 155 time premium that we paid in the option declined, but we've got that nice intrinsic gain. So let's call our liquidation value 926, would have been a profit of 616 or 198%. Extremely profitable position because of the earnings surprise. The far out strangle, the cost is 520. Of course, with the 15 July 110 call, priced about 40 cents, still some time value remaining. July 100 put was at 840. So our liquidation value would have been 880. With a cost of 520, that would have only put our profit at 360 or 69%. So why am I showing this, of course, if I had said that buying options not necessarily the way to go with the weekly positions? Well, this is based on an upcoming event. Okay? You need that sort of impetus if you're, that kind of catalyst. If you're buying a straddle or strangle with weekly options, even 2 weeks out or maybe 3 weeks out, trying to play an upcoming earnings event, maybe ruling on a patent lawsuit or anything along those lines. Without that catalyst, Ernie and I have attempted to do various searches for long calls and long puts, just buying calls and buying puts, trying to follow the market, speculating on a market direction using a market sentiment tool. Are we bullish over the next 5-6 days? Are we bearish? And so forth. And what we found with buying calls and just buying puts using weekly options is a mixed bag. You really have to be right close to 70% of the time, because when you lose, if the stock doesn't go in your desired direction, you get to 100% loss on whatever you paid for the position very quickly, within 1 to 2 days. You can see large profits if there's an unexpected move in the stock or a good move in the stock, and we're talking in the range of maybe 50%, 100% or more because of the low cost of the weekly option to begin with. But you do have to pick right more often than wrong. Of course, that's in general with every strategy, but it's really pronounced when looking at the long calls and long puts for weekly options. The strangle, the far out strangle here still would have been profitable, but of course it doesn't compare to the earnings event using the weekly options. Okay, so going backwards, trying to make a portfolio consistent of just buying cheap calls and cheap puts, speculating in a market direction using weekly options, we don't feel shows a lot of success. However, playing earnings with an out-of-the-money strangle, or perhaps a straddle if you wanted to pay more money using the same strike price, that might result in higher profits if there is a reasonable move. What do I mean by a reasonable move? I was in Texas Instruments recently. They had earnings. It was really positive. This was back end of April as well, I think the 26th or the 25th. So the earnings were very positive. The market was down that day, and Texas Instruments only moved up about 2 or 3%, and then fell the next 2 days after it with the rest of the market. Had the market been bullish, I would have expected Texas Instruments to gain 5 or 6%. The reason why I bring this up is that the weekly strangles, when the stock moved from about 58 to 61, and the far out strangles showed very small profit. Both of them were profitable, but they were very small, underneath the line of maybe 8% to 6% or so. Still a profit, still not bad, but nowhere near the numbers we're talking about when you're expecting a very large earnings surprise. Okay, so that's just what we want to take away from that brief discussion. So our sentiment, again, is that just buying calls and buying puts, speculating market movement can be profitable, but so far all of our studies and all of our research back testing has proved that it's a mixed bag. Shorter term straddles and strangles based on an earnings movement can be very profitable, but you need that unexpected move as well. Oh, sorry folks, there you go. Thomas says, should the screen still show on Apple? Yeah, I should be showing the Apple slide here of the 27, just comparing the two numbers. Thomas, that's where I'm at right now. I haven't moved on here. I'm just talking about in general. I don't have a slide for the Texas Instruments position comparing those two. I was just using that as an example. All right, so let's move on now. What are the income strategies that are most commonly used by investors trading weekly options? When we talk to customers who are trading weekly options, what we see in the market, well, it's what you kind of know. We just like to review it for those of you that are new. The common strategies that are used for the weekly options are the vertical spreads, the bull put, bear call credit spreads, or maybe even the bull call and bear put debit, which are parity trades. Iron condors and butterflies. I typically don't trade iron butterflies because I'm not great at pinning a strike price. Many investors do trade covered calls and naked puts, but what I have found is that the investors who are trading covered calls and naked puts with weekly options are not new investors necessarily coming in and starting out trading options looking to apply the weeklies with covered calls and naked puts. Most of the investors I talk to who are doing weekly options with those two strategies are investors who've been trading those strategies in their portfolio for a long period of time and just happened to be in a stock maybe 5 or 6 years ago when the weeklies came out, okay? Okay, I'll get to, there's a question that came in for Frank, and Frank, I'll get to that in just one moment, okay? All right, so now with the advent of weekly options, there's also unique opportunities with collar spreads and calendar spreads. Now many of you know that there's a standard collar spread where I might buy the stock, sell a 1 month out or a weekly call out of the money or at the money, and then also buy an out of the money put as well. Okay? So it gives us a nice risk-reward profile. We might have a potential for 1 or 2% return if assigned with only risking 3 or 4%. It's a very similar profit and loss chart to a bull put credit or a bull call debit. Okay? But with the advent of weekly options, we do have the opportunity now, instead of buying the same expiration, I might be able to buy a 3 or 4 month out or even a 1 month or 2 month out of the money put and sell weekly calls against it to sort of create a calendar position. And of course, many of you might be familiar, whoops, sorry folks, let me go back one, I apologize for that. There we go. Many of you may be familiar with the calendar spreads, of course, where I might buy a call that's 5 or 6 months out in time and sell month by month against it. But with the advent of the weekly options, we now have the opportunity to create shorter term calendars, very short calendars, where I could buy a 3-week out, 4-week out, 5-week out, or maybe 6-week out call or put, either in the money or out of the money, depending on your structure, and then sell week by week by week against it to create that similar sort of calendar profile as well. Okay, now that's just some of the preferred strategies, is because just the basic rule of options is that selling closer and closer and closer, week by week by week, month by month by month, we get a better annualized return. So the premium strategies might be considered a little bit better than buying options. However, of course, there are things that we need to discuss and problems that come with doing these different strategies. So with the advent of the multiple expiration date, strike selection is more troublesome, if not more important. We talked about already 50-cent strike differences, dollar strike differences. When you're doing a spread, you have to decide what is the margin requirement, what is the difference in strike prices that's best for your portfolio. But in addition to that, we have to factor in the time frame and the probability. We have to make sure that the risk reward is not unreasonable. Okay, if I'm doing a spread position, let's just say I recovered and I'm bullish on Apple now that at 93, I want to do a bull put credit spread for next week, maybe even this week, 2 days out. I might look to sell the 92 put and let's say buy the 91. So I have a 1-point strike difference. But if the midpoint net credit is only 7 cents, is it worth it to make 7 cents to risk 93? Well, no, you're going to have your own trading plan set where you have your minimum return requirement, and that's going to appear, okay? And an important thing we're going to look at when we start looking at some of the profit and loss charts for the positions is that you have to consider commissions more closely when doing any weekly position, because it's going to take a larger effect into your portfolio as well. All right, so let's assume all of you that are here are interested in weekly options. I'm going to launch a quick poll before we navigate over to PowerOptions, and I just want to know what kind of strategies are you mainly trading right now with weekly options or researching with weekly options positions? Are you mainly looking at just covered calls and naked puts? Are you looking at the credit spreads or iron condors? That would include debit spreads as well, of course, vertical spreads. Are you looking at horizontal or diagonal spreads, the calendar spreads? Are you buying calls or buying puts? Or are you doing the protective positions as well? All right, so we've got about 27% vote. I'm going to leave the poll open for about a minute. I have a feeling that several investors here that are online with us are laughing at me from my last discussion. Jerry asked a question, then I'll get to Frank's while you guys are answering the poll. Jerry asks, how do diagonals fare for weekly options? I'm going to be honest with you, Jerry. I'm going to say hit or miss. I used to trade diagonal spreads with a larger portion of my portfolio back before weekly options were available. At one point, diagonal spreads were the most profitable and most successful strategy, both monetarily and percentage-wise, that I've ever traded. 5 or 6 months after that, diagonal spreads resulted in the largest losses that I've ever experienced in any option strategy. That being said, I have attempted in the near future, in the recent past, probably for the last year, I've gone in and out with trying to create different searches and different structures for using weekly options for diagonal spreads, and I have yet to find a structure that I feel comfortable with that will work across most, of course, market conditions. So I just haven't been able to do that yet as well. Okay, let's see. Johnny says that he's going to leave right now. Okay, sorry, Johnny, that the presentation didn't match your needs. I do apologize for that. Frank's earlier question, he says, what I don't understand is the SPX market closes at 4 Eastern, and some of my weekly credit spreads were filled after the close. Okay, yeah, it's just the way the settlement is done. Okay, so SPX closes at 4 o'clock Eastern time when you're looking at the weeklies. Then what the market makers do is the same thing they do for the regular standard expiration on SPX. They essentially, the last time to trade the SPX options, the standard expiration is Thursday at 4 p.m. Okay? And what happens then Thursday at 4 p.m. is that when the market opens on Friday, that's when they start the settlement prices for SPX. They look at all the stocks in the SPX. Oh, sorry, folks, let me close the poll and I'll just share the results real quick. But they do the settlement, so the true settlement price for where SPX closed might not come out till 9:40 or 9:45. And you can be stuck in that position with weekly options on SPX where it looks like it's maybe, let's say you played it very close to the vest, Frank, and you were $1, straight dollar, 1 point, not 10 points, not 100 points, but 1 point out of the money with a bull put spread when SPX closed at 4 and you thought it was going to expire worthless. But then you see it around 5 o'clock, 5:15 at your broker, they actually had to close the short put for you for a small loss, a cash secured loss. Okay, and unfortunately that's because of the settlement price. Okay, the settlement was done later, and so it may be there. So as a general rule of thumb, if I'm within, maybe even 0.5%, if the SPX is within 0.5% of my short call or my short put in a vertical spread, then I'll look to close the position ahead of earnings just to make, ahead of the expiration just to make sure. All right, so the winner today, of course, as I expected, 57% of you are doing credit spreads and iron condors with the weekly options. 49%, roughly half of you, or about half of you, are doing covered calls and naked puts. 30% of you are buying calls and buying puts. Maybe you're doing earnings or not doing earnings, but you're buying calls and buying puts. I hope you're being successful. I have not been successful, as I mentioned earlier. 30% of you are doing the protective positions, and 22% are doing the calendar spreads as well. All right, so that gives us a little background there. All right, so Jerry says, yeah, you got hurt by diagonals before. And Lauren says the SPX trades till 4:15 on Friday. That's right. Oh, Fitzroy says it's greater than 100. Yeah, Fitzroy, you can answer more than one. Okay, that's right. So we have people doing credit spreads and covered calls and maybe buying calls as well. And that's why you got more than 100% on the poll. All right, so let's go ahead and hide that. And I want to navigate over to the PowerOptions suite of tools. All right, now to begin, let's talk about, we've already got bull put credit, bear call credit, and some of our strategies set up as well. Let's see here, we've got long put added, we'll keep that there, and long collar there also. Okay, I don't have calendar spreads there, so let me go ahead and remove the custom spreads and we'll go ahead and add calendar call to our configuration. Now what I wanted to start off with, of course, is let's talk about credit spreads, whether you're doing bull puts, bear calls, possibly the combination of the two, the iron condors. The first thing I want to set up for you is let's go into the main search in PowerOptions, and this will pull up the listed trades that match our default criteria. Okay, now I have it set already to the weekly bull put spreads. All right, and this is just one of the defaults you'll see. So anytime you go into PowerOptions, you go into the search, if you're in covered calls, naked puts, debit spreads, or credit spreads, you'll be able to scroll down below the listed trades and set the default setting to use as a stepping stone for weekly bull puts. Reason why I'm bringing this up is I want to show you some of the concepts and some of the criteria that Ernie and I have tested that we feel works better over a longer time horizon for both bull put credits and bear call credits. Now we know, in general, if I'm doing a credit spread, the leverage works for me. In the old days, when an investor would call up and ask me, what is your expectation for a profit on a reasonable bull put credit spread that has a good probability? Okay? And in general, I'd say that, well, what you're looking for is probably about an 11 or 12% leverage return for a 30-day trade with having a good probability of 75 or 80% that the stock would stay above your short put strike price. What does that mean? That means, well, in the old days when we just had the standard expiration, I'd expect that if let's take just Apple again, trading at 93. If I sold the 90 put and bought the 85, did a 5-point spread, I'd expect about a 50-cent net credit off of a risk of $4.50, the true risk of $4.50. So that comes down to a 9-to-1 risk-reward ratio for a credit spread, which is common when you're looking for a 75 or 80% probability or higher. Now with the weekly options, in any strategy, the income strategies, our expectations for return, of course, and net credit, we have to scale that back. So if I was expecting originally about 50 cents for a standard spread with a good probability, if I'm going to cut that in force, I'm going to look for a net credit minimum of about 15 cents. Can we find weekly credit spreads with a 50, 60 cent net credit? Of course, but the margin's going to be a little bit wider. All right? If I found $1 credit on a spread that's going to expire in 4 or 5 days, I'd expect it to be on a 10-point spread, assuming that I'm still keeping that 70% probability and not going to just one strike out of the money or at the money, for example. Okay. Now, if my expectation is 11% over a standard 4-week period, then I'm probably limiting my percent return to be about greater than 2 or greater than 3%. Can we find ones with higher? Absolutely. But the key is normal expectations for what you'd expect. Those of you that are trading spreads, the 57% of you, have probably found spreads that offer 12, 15, even as high as 29 or 30% returns in a 4 or 5 day trade. Okay, and that's great when it works out, but what that probably did is lower the probability of success and your range out of the money as well. Now, for the bull puts, these are just some of the basic option criteria I'd look for on a weekly option. And also, of course, I'm going to look for some things that match my requirements for a bullish position. I want to look for stocks that are in an uptrend, maybe stocks above the MACD, where the MACD has crossed the signal line, and with any income strategy, any strategy where I'm selling premium, whether it's a diagonal, whether it's a credit spread, condor, butterfly, covered call, or naked put, I want to avoid earnings between now and expiration. I don't want to be in a covered call on Apple, just bought the stock at 105, sold the 104 call on April 25th for a 4-day return of 2% with earnings coming up. Because if the stock drops down to 93, that 1 or 2% I gained for selling the 104 call helped the loss, but now I'm still looking at close to a 9 or 10% loss that I have to manage over time. So I want to avoid any of those surprises. I just saw something this morning, by the way. Fossil is one of the stocks I used to trade when it was in its heyday, up in the $80 to $90 range. I saw today that it just dropped 30% because of earnings and because of the Macy's pull down as well. It's now trading at about $12 per share, so that was kind of surprising. But it's not a position I would have done with an income strategy headed to earnings, I would have done a straddle or a strangle against that position. Now, what is the one glaring thing that probably stands out to most of you? You're looking at this screen and seeing the option criteria that are used, and I've highlighted the stock criteria, the fundamentals and technicals. What's this expiration time frame? In this default search for weekly options, Ernie and I have set it up to go all months to expiration, look for any expiration date available, but to be between 8 to 17 days out in time. Why are we going to essentially the 2-week out period when we can find good returns that are maybe only 5, 6, 7 days out? The reason why is because back testing the different credit spreads, bear calls, bull puts, even the debit spreads, we found that across different markets with some management techniques in place that we would use on any standard position, that it is more profitable long term to go to the 2-week out cycle than the 1-week out cycle. I know there's a lot of allure and there's a lot of promise and potential, and I know a lot of traders that do this where they're going to look Thursday morning to find positions that expire on Friday. They just want to be in a credit spread for one day and look for a small net credit of maybe 10, 15 cents, maybe even less, with a 1-point or 2-point strike difference, and that's great. But if I'm only getting 8 cents per credit, I still have a good probability, and I'm taking a 1-point or a 2-point risk, one loss is still going to wipe out 10 previous trades. So if something happens Friday morning or late Thursday afternoon and that spread moves against me, well, that's just the nature of spread trading. We all know that. But it has that opportunity with only a 2-point move or a 1-point move to completely wipe that out. So we found that going out to that 2-week period gives us a better historical report, better history gain and loss ratio than just going with 5 or 6 days out in time. Okay, now let's talk about some of the other things that I like to look for. We don't have it set up in this particular search that was tested by Ernie and back tested to look for more positive gains. But one thing I prefer to do, as we've talked about with the advent of all these 50-cent strike differences and dollar strike differences and so forth, my preference in general, you see the first one here on NOV, National Oil Well Varco, is selling the 31 put 9 days out in time for 43 cents and buying the 30 for 25. Now, this is going to yield an 18-cent net credit off of essentially an 82 cent margin requirement, which would result in a 22% return. When I'm looking at weekly options personally, let's just go to the profit and loss chart here. I'm going to take a look at some examples, and let me clear this out, erase those drawings. Okay, so there's a profit and loss chart of our bull put credit spread for NOV. Not a recommendation or suggestion. I haven't done any research and analysis on this. We just want to take a look at the chart. The stock's at 32.36, so we're about $1.36 out of the money for our 31 strike put that we're selling. Okay, we did have a probability of 72.4%. Okay, so it's a reasonable probability. I could increase that, and we'll walk through that in just a moment as well for the credit spreads. Now, what I typically prefer to do in these type of strategies, credit spreads of course, is I have a 1-point strike difference, so my margin requirement would be 82 cents, which gives me the 22% return. And this is again for about a 14-day out trade or 15-day out trade. Okay, but what I tend to prefer to do with these positions is I always like to keep, let me go to view options, let's go to May 20th. This does offer the 50-cent strike differences, so we did see a 1-point move. Now, this might be okay for me to use a 1-point move personally. What I like to do is keep 1 strike apart between my spreads. If this stock only offered 1-point strike differences, I'd be more tempted to see the risk reward of the 31 to the 29. I'm going to increase my margin. I'm only going to pay half the cost that I would pay for the 30 put, but I am going to increase my margin, so my return's probably going to drop to that 15-12% range. Okay? The reason I like to do that is because this is such a short-term trade that if tomorrow is a bad day, you know, we saw this stock currently trading at 36, but if tomorrow is a down day and the stock falls, let's say, a point and drops to 31.36, I'm now within 1% after one day of my short put strike price. That's usually a trigger that I use to manage these positions, whether I'm in a naked put, a bull put credit spread, or a bear call. When the stock reaches within 1 or maybe 0.5% for a weekly position of my short put strike price, I'm going to look to manage it. So why do I want to keep one strike apart? Well, because of the short time frame. If it does start to move against me and I fear the stock showing weakness and it might drop below 31, I may consider buying to close the 31 and selling the 30.50. Okay, I don't have to adjust the 30 put. I don't have to move both strikes down. The reason why I prefer to do that is rolling just down to the next strike with your short option, if it's being threatened, should count as just one commission. Okay, you should be able to just roll the put down in your brokerage account in one position. If I liquidate my 31 and 30 put and then try to roll down to the 29, let's say 28, I may pay as much as 2 commissions, maybe 3, depending on how your broker treats that. That is going to be detrimental to weekly positions, okay, adding that much commission. So I'm going to look for the shortest commission available. I tend to leave one strike between the two, okay, and then I would look to manage the position as the stock moves against me. If the stock moves up, hey, I don't care, right? I'm just going to go ahead and do that as well. Okay, we're just going to let it expire worthless, for example. All right, but that's one of the things I like to look for in my spreads, is to keep at least one strike difference available. So if there is an unexpected down day, then I can look to just manage it with one position. Let's just take a look very quickly at the comparison. What happens when we extend, I should say, or increase the strike differences to get a better net credit? Well, I'm still selling the 31 put at 43 cents. Now if I go to deeper strikes, if I buy the 29 put, let's call it 13 cents, we're going to take in a 30-cent credit now as opposed to the 18. Okay, fantastic. We get a higher net credit, but now our margin goes up to 170, because I have to cover the 2-point spread, but I still collect a higher net credit. So I have a lower percent return based on my margin requirement, and that would continue as we went down the scale. Okay, so as I continue to go to a 3-point spread, a 4-point spread, you're getting a higher net credit, but your margin is going to increase more than the net credit you're going to receive. So is there a balance? Yes, there is a balance. As we talked, naturally, the highest return you'd see in any credit spread is going to be the one with the smallest strike difference. Okay? Well, assuming, of course, we're mirroring the same short strike using the 31 combination. Okay, so if I did the 31 and the 30.50, I'd have a lower net credit, but I'd have a much higher percent return on margin. The 1-point spread here, we saw that would be 22%. The 2-point spread drops us down to 17.6, even though we're getting a higher net credit, and we'd see that consistently, okay, throughout the scale. Let's take a brief look back at the search tool. I'm going to show you an example of that on NOV here as well. So let me just go to the search by symbol tool. We're just going to look at May 20th, 10 days out. I'm sorry, it's 10 days out in time. So what do we see here? This is the example I was talking about. It's not always using the 31, but let's start here on the 31 block. Okay, so here's the 31 strikes that we see, and of course the 50-cent strike difference gives us only a net credit of 9 cents, but that's a 22% yield with the same probability. In this example, if I can make 9 cents on what would be a 41-cent requirement, which would be a 22% return, a 41-cent margin, or I can make 18 cents on the 82-cent requirement and leave a strike difference in between here with the 31 and 30 with the same return, I'm definitely going to take the 2-point strike difference. To me, that's a no-brainer. Okay, yes, the margin requirement is twice as much, but the net credit is higher. And that would balance out. If you decided you were only allocating, let's say, $1,000 to this trade, you might do 20 contracts of the 31, 30 and a half, and do 10 of this one, but the money would be the same, be $180 net credit versus often about an $820 margin requirement. All right, and then of course as we go down to the 1.5-point spread, we see it drops down to 19, but we have a higher net credit, and we already saw the 2-point spread as well. Okay, so that's what you'll expect in every stock. It's a balance of what are you looking for net credit versus what are you looking for for percentage return, and of course your margin requirement as well. Now let's go back here very quickly. I'm going to look at this 2-point spread here again. Taking in a 30-cent net credit by selling the May 31, next week's May 31 put, and buying the May 29. Get a 30-cent net credit for a $1.70 risk. A couple of you I can see in lists here were online a couple months ago when we were doing our open discussion, open forum presentation. The customer called in and said, you know, I have about $1,500 that I'm allocating in my portfolio, and I want to trade credit spreads using weekly options. I want to do about 5 or 6 spread positions. Is this going to be profitable? Well, it's a tough way to answer it, okay? What I mean by that is that let's say that we were only going to allocate $1,500 of our portfolio to trading vertical spreads with the weekly series. And now I decided that I want to maybe put $400 or $500 into each one, so I'm going to have 3 different credit spreads allocated. So we've got $500. Now, with this particular position, it would work out pretty well, wouldn't it? On average, so let's say that I could do $500, maybe I'd allocate a little bit more. With a 170 margin requirement, that leaves us at 3 contracts, which would put us at $510 allocated to the position for the margin requirement of 170. Of course, we'd be making 90 cents on the position, and if your commissions were 15 cents, well then, that would work out well for you. Or $15, or even $12.95, okay? So you'd still be making $78, $80, let's say, per position against the risk of $510. It'd still be a 15% return. Now, the problem for this particular customer comes with the fact, and let's take a look back at the search, that he only wanted to do spreads that had an 80% probability or higher. Okay, so let's change our bull put credit spread weekly screen to look for 80% or higher. And we might not have any results that match our specific criteria, but that's okay, as we'll just have to adjust our requirements for net credit and, of course, range out of the money. Well, here's a few. And I'm just going to look. There's a 2-point spread, and there's a 2-point spread on Facebook. Okay, so yeah, let's go ahead and switch gears now. So here's our 16, oh, that's 16-day out. I don't want that. I just wanted to look at the 9-day out. And that's fine. Okay, so we've got a couple with the 9-day out spreads here as well. We'll take the one on LinkedIn, which is showing a 24-cent net credit. Okay, so once again, taking a look at the bull put credit spread here, similar requirement, 24-cent net credit off of a risk of $1.76. Do 3 contracts, but it'd only be about $72. Okay. The problem comes into play when the investor says, I want to do shorter term series. I just want to do this week. And that's where we were. So we're going to change our settings to 0 to 5%. I'm going to lower the net credit down to 10%, or 10 cents net credit, and a 2% return. All right, so now what we take into account is we have some positions here. Let's see, good 2-point spread there on LinkedIn. Again, okay, so we keep LinkedIn with a 2-day out spread. Let's take a look. LinkedIn currently at 130. Sell the May 13th 126 put for 31 cents and buy the May 124 put for 16. This gives us a net credit of 15 cents with a risk of 185. So again, in this position, we could do allocating $500, or in this case, we'd have to go up to, what is that, 530 roughly. Let's call it 530, okay? And to make 45, okay? It's a little bit less than that. So with the 3 contracts now, we'd have 45 cents. Let's put 10 back in, so that puts us, of course, at 35. Now that's not a bad return still, potentially. We're going to lower this down to about 6% yield for a 1-week out trade. But is that going to be worth it? We already saw that we could go 2 weeks out on LinkedIn. Let me clear these out. We could use the same spread with the 126, 124. So we'll call that 120 and 80 for opening the position. All right, so now we get a little bit higher, only a 40-cent net credit, but for a risk of 160. So again, we could do about 3 or 4 contracts and we'd get about 120 in now, as opposed to what we just, the premium we just saw, the 35 cents as well. So it's still a 25% yield. It's a little bit higher. The key is that based on your account size, you're going to have to factor in. Question comes in, why wouldn't you look for higher probability if they're still available? Well, you can. Okay, you can use the search tool to find anything here. We see these positions have all above 90% probability. But the key now is, let's go ahead and filter that down. Let's just look for the bull puts that are 2 days out that have a 90% probability, still in an uptrend to match other criteria. LinkedIn, Chipotle, Amazon is up again today, and Allergen also. And you see here that the premium is not that bad, but your returns now, of course, you're going to be at a 3% return, 5.3%. This one on Amazon, here's sort of the kicker. This is the one that won't work for a smaller account and allocation. To do Amazon, I'd have to sell the 695 put, buy the 690, 94% probability above, and we get a 25-cent net credit. But if I'm only allocating $500 for the margin requirement in this position, 475, I would only be able to do one contract of this position. I'd take in 25 cents, but then my commission fee of 10 cents would make 15 cents or $15 total off of a risk of 475, roughly, to begin with. Is that worth it for a 2-day trade? And someone's going to say, yeah, the annualized return is going to be much higher. Right, but can I make this trade every 2 days? No, I have to use the weekly, so I know that if I made this trade 2 days, next week I could make it a 2-day trade if I opened it on Wednesday, but there were 6 days in between. I'm not getting that 5% or what would drop down to probably the 3% yield after commissions for the Amazon position every 2 days. Right? I'm getting it only a shorter time frame. Okay, so that's just some of the ideas. With the allocation, it becomes very important to think of your commissions. All right, now, as I mentioned, this is the tested criteria that we've seen for bull puts, the weekly bull put spread. Ernie and I found that this setup worked better over a longer time horizon than trying to go to the 3 or 5 day out positions with the same criteria and with different criteria as well. So that's why we're starting off looking at the 8 to 17 days out. You'll see that on the Bear Call Credit Spread Weekly Default Search, as well as others. But the key here is that you can customize this any way you want to. John commented, he says, I only do credit spreads on indexes and ETFs where I have an 85% probability and a minimum return of 4%. Okay, let's start that off. So what I want to do, I can clear the filters real quick, and I can customize this any way I want to. For John, we're going to put our days to expiration to be 0 to 5 or 0 to 7, just to get the most current week. Go ahead and put in a net credit of 10%, looking for a return of 4%, and we're going to look for that probability of 90% or higher. And now what I'm going to do is just go to the lists. Okay, and I'm going to just select to go against indexes and ETFs, and I'm going to choose to remove this ETFs to remove from standard searches, which is a combination of the leveraged ETFs, the 2, 3, and 4 times ETFs in some cases, and also the counter market ETFs. It's a list I created. We can do the counter market, the inverse ETFs, remove them from our list, or the leveraged. I actually just combine the two together to remove both from my searches. So let's go ahead and submit that. All right, and so now we have about 34 total results on spreads that expire in the next 2 days, where probabilities, 97 ranges, and of course the net credit was at least 10 cents. Okay, so with good returns, you see the single-digit returns for 2 to 3 days, but there's some double-digit returns in there as well, and things that I have never traded before. But we do see SPX in there. We see some of the gold in there, the Russell 2000 also. So that's a quick way. You can create the search based on your criteria. If you want a higher probability, just accept that you're going to have a lower net credit, but you'll be able to limit that down as best as you want. Okay, so Frank says, when searching for full credit, would it be wise to determine the general trend of the market is up? Of course, Frank. We're just showing this as an example of some of the concepts that we apply to credit spread trading. what I just showed you would be the same for bear calls. I pick my market direction first, whether I'm bullish or bearish. One of the tools that we use here, let's go ahead and load that up on the home tool, is the market sentiment tool, which is a collection of 13 broad-based indicators across the market. And three of the indicators are currently bearish: the VIX, the number of days the SPX has been over its 100-day moving average, and the put-call volume ratio have triggered bearish. If two more indicators go bearish today, you'll see a sell warning here. It'll turn to red where it says neutral, and we'll see a sell warning there. And of course, at that time, I might be looking to do bear call credits. With a slightly bearish trend right now, I may look to do iron condors, but set up my iron condors where the bull puts further out of the money than the bear call if I have that bearish sentiment as well. Okay? All right. Now, I just wanted to mention, everyone, of course, is that when we're looking at that, when you go to bear call credit, if I added that in, I'll replace it with the bear put debit real quick. Sorry, folks. So go to bear call credit, add that in. If I did decide, Frank, that I was bearish on the position, I'm sorry, on the market itself, when I go into the search there, again, I'd start off with the weekly bear call credits. And as you see, once again, we're going 8 to 17 days out in time and looking for stocks that have currently moved in a downtrend or have been trading. Of course, you see Apple, Netflix, Baidu. I didn't think Disney would come up here, but I wouldn't be surprised if it did after today's earnings. We'll see how that strength comes out over time as well. Okay. Byron asks, does the tool search the strongest or weakest sectors to trade? No, but you can select. This is searching across the entire universe of options right now. I could choose to screen just against IBD 50 stocks, S&P 5 stars, Standard & Poor's stocks, for example, the NASDAQ 100 if I'm bullish or bearish on one of those sectors or industries. But you can also screen against or filter to screen just against particular sector or industries, or remove particular sectors or industries. If I'm in bear call credits and I currently think that, let's say, gold right now might be bullish. That's not truth, but if I thought gold was bullish when I'm screening for bear calls, I may remove gold or the other metals or basic materials, depending on sector or industry. We do show back on the main home tab in the Learning Center, you can see the current sectors and industries that are gaining or losing today, but it's not an indication of sectors or industries that are strong or weak right now and going forward over the next several days or weeks for that matter. All right. Now, I want to address very quickly, go into some of our other strategies. Those of you doing covered calls and naked puts, let's just talk about that basically. If I go into covered call again as we did with bull puts and I go to search, as before, you can go to the weekly covered call search. This default criteria, this one's a little different. We're going 1 to 10 days out. Okay, we're going shorter term selections, different stock ranges, but you can customize that as well. We're looking for stocks that have shown growth, have a good average stock volume, have grown in earnings, and of course avoiding upcoming earnings as well. But again, you could customize it any way you want to. Ernie did test these as well, and we found that historically testing, going about 1% in the money or more, or slightly in the money, over time gets a better yield with the weekly spreads. You can still find reasonable returns. As I mentioned, you know, looking at a 3-week or 4-week out standard covered call position, I'd usually hope to expect maybe a 2 or 3% return if assigned or unchanged. So we want to scale that back here and look for a return of at least about 0.6% return if unchanged. But you can customize it any way you want to. If you want to speculate and go out of the money, well, we would just change the range to show us just out of the money options, and I might lower my downside protection or my percent return if unchanged, similar to what we did before. But as we saw with recent examples, discussion on fossil and of course Apple, I wouldn't want to be in one of those positions where the earnings is coming up between now and expiration, or an out of the money cash secured put where the stock would fall quickly against me as well. And of course the naked put, the same thing. You go into the search, start off with that default weekly naked put screen as a stepping stone to create your own personal search. And you'll see the similar criteria. Of course, we want stocks with good volume that have shown earnings, positive earnings growth, avoiding earnings between now and expiration, and stocks that are trading in an uptrend, because a covered call is essentially a parity trade to the naked put position. So we look for the same type of stock criteria and a very similar return as well. All right, now very quickly jump to calendar calls and calendar spreads, and I'll discuss the collars also. When constructing a weekly search here, I don't have a default for the weekly search as I mentioned, because I've been trying to create one that works well historically over time. But when you're starting off creating a search for potential diagonal positions, it's best to just start off with clearing the filters first. Empty everything out. And then I know that what I'm going to do is search for positions. Let's keep it in this current week. For my near-term option expiration, I'm going to go all months, 0 to 2 or 0 to 3 days out in time. Let's put it 5. And let's go 4 weeks out. I'll leave it at all expirations or all months again. I'm going to go 20 days to 30 days out in time. And one of the advantages of doing a diagonal spread with shorter-term weeklies, of course, is we can pay a lower debit. So I could look for a debit here, the net credit field. I'm sorry, folks, of let's say less than $4. Okay, a small credit. I want, maybe a max return as we saw before of 5%, and I'm probably going to want my near-term call to be at least 0.5% out of the money or more, maybe even 1% out of the money to allow some upside. And if I'm buying in the money, let's just put it at least 1% in the money or more. Now, those of you who want to set up positions, of course, where you're looking for calendar spreads, diagonal spreads, you're buying in the money, selling out of the money, you're probably looking at a delta ratio. Okay, a delta ratio meaning the delta of the long option that you're buying divided by the short option. You're probably going to want to look for that to be at least 0.6, okay, as a starting point. I'm sorry, 1.6 as a starting point, okay, so that you have a good delta ratio there with the long option gaining more than the short options declining as the stock moves up. Of course, you could put in some volume and open interest as well. And one of the most important factors is that you may want to look for the implied volatility ratio also. This is the only time I really use Greek's implied volatility, and Greek's delta and gamma is when I'm doing these calendar spreads. The implied volatility ratio is simply the implied volatility of the sell option divided by the buy. So I might want to make sure that my near-term IV has a higher, my near-term IV is higher than my farther out IV as well. And of course, because this is a neutral to bullish strategy, I might want to look for stocks that have shown an earnings per share growth of at least 5% or more. I don't want earnings between now and expiration. And I might want to see some stocks with good average stock volume as well. Just as a starting point, let's go ahead and submit that. All right, so we have 74 total results on the position. This one might be a little bit too much. Yeah, see, I see this here just on the recent top results there, Jerry. I'm looking at the counter spreads. We have our short options only at 3 cents, 6 cents, 4 cents. That's not enough for me. So I'm going to scroll back down. Even though I'm keeping my net debit to less than 4, I'm going to want the option bid, my short option premium, to also be at least 10 cents or more. There were some in there. There we go. So we narrowed that down to 58 results here. We have positions on Baidu and Whirlpool and so forth. The first one here at Baidu, still not what I'd want. I would customize this a little bit. What I mean by that is, let's take a look at Baidu here. It does match my criteria that I just put in for the diagonal spread. I'm looking at a June 3rd 160 call, so it's about 4 weeks out in time, and this week's May 170 at 33 cents. Now, the stock is currently trading at 162.93, and I'm buying the 160 call and selling the 170. I'd probably want to take a look at this and see what my numbers would be if instead of selling the 170, what if I did the slightly out of the money, maybe 167.5 or the 165. 165 might be a little bit too close. I'm sorry, my premium here, about 75 cents. There we go. All right, so here's a 4 week out roughly long call with a 2 day out, 3 day out short call. Still return within the range that I want, still the debit that no, debit is too high. Yeah, so it'd be 730. That's why we didn't see that in the result, because the debit was beyond that $4. But the return still looks pretty good as well. Okay, so that's just the ways to set up the spreads. Again, I have 2 or 3 customers I talk to, PowerOptions subscribers I talk to on a regular basis who are using these calendar spreads. I've talked with them about their criteria, how they're setting it up. They've had mixed results. I've had mixed results, so I'm still looking for a good weekly search for the calendar spreads. And as soon as I develop one that I feel consistently works, you'll have that in the calendar call, and the calendar put is one of the default searches to use as a stepping stone. All right, James has a specific question about a position he's in, so let me go ahead and take this out here and go back to custom spreads. All right, and James is looking at the SPX, which expires today. Oh, that would help, wouldn't it? Let's put in our symbol here. Now, this type of strategy is the May 12th. This is the Wednesday series, of course. Technically, it expires today. And it's a bull put, I'm sorry, credit spread 2070, 265. Okay, so let me just open that up, 75 to 90, so I could probably sell that for at least 80. And then, of course, we could buy, now let's call that, be nice to ourselves, let's call it 25. I'm not sure what your net credit was there, but let's say we fought and we won, so we get a net credit of about 55 cents, okay? So now, what James is looking at is closing this position at a 50% profit. Okay, so if the stock moves up or decay starts to work in his favor, he can close this at the maximum expected gain was 55 cents. So he's going to look to close it when he sees a debit of 27 cents or hopefully lower, maybe 25 cents or so we can get 50% profit on it. Okay, what do you think? The first 2 thoughts that come to my mind is, number one, I'll be honest with you, it's good that you're looking to close for the gain to make the profit on it. It's not a guarantee that you're going to get it. You know that as well as I do, but that's great. Okay, so you're going to look for a position here. The one thing that I couldn't do with this position, I couldn't trade it, James, personally, is because even if I put in contingent orders, if there's a sudden gap, of course, the contingent order would get filled wrong. Because if I'm looking to make a 50% profit on this position, I'm looking to close it when I make 50% profit, I'd also probably have a contingent order in there if I take more than a 50% loss, meaning if the liquidation value of the debit between these two in the next 4 hours or so is 75 cents or higher, okay? Well, let's call it 80, okay, about 75, 80 cents or more. So if I have a loss of 50 or a gain of 50, I'm looking to close it. But if there's a sudden shift and this moves quickly for whatever reason, not likely to happen, but if it does move quickly, I might take a severe loss. The contingent order get triggered, but they might not be able to fill it at exactly the prices I wanted. Now, if you're doing it manually, you're watching the markets, this is the other thing. I can't do this. I personally can't do this position because I don't have the time to watch the markets on a continual basis to pinpoint when this position is going to close me out for a gain of 50%. Okay, I'm doing too much with the webinars, articles, phone calls, coaching sessions, so I can't watch it. This is why I don't trade. I did backtrack a little bit. About 6 or 7 years ago, no, about 8 years ago, I had roughly 45 to 50% of my portfolio allocated to credit spreads on the broad-based indexes and ETFs, and I could not make it work. The reason why I couldn't make it work is I did not have the time during the trading day, because this is what I do during the trading day, and I needed to watch them more closely. Even using 1 month out series that were 3 to 4 weeks out in time, trading those positions on the credit and debit spreads, I didn't have enough time to watch. I was taking too many losses for movements that were occurring in the beginning of the market day or at the end of the market day when I was maybe on a coaching session or hosting a webinar with Kurt, for example, and so forth as well. Okay, so the time allocated to watching these positions doesn't match what I need. Another thought that comes in, okay, is that you open this spread at 2070, SPX is at 2075, you did the 2070 to 2065, and you're going to be happy with a 50% gain, so 27-cent profit on this particular position with a 5-point margin. Okay, you'd love to have the 55 cents, I understand, but you're looking to be comfortable with this 27-cent profit, and that's great. For someone like me who looked at this position and said, okay, well, I don't know your track record, James, but if you're right, let's say 50% of the time, and you're able to close these out for the 50% gain that you want, so 50% of the time you make 50%, let's say 25% of the time you make the full profit, and 25% of the time you have to buy it back or you realize a small loss on the position, I'd say that if this was the case here, what I might consider doing is opening the spread right now, today, that offers this 27-cent return. So if possible, I might open the 2065, 2060, which is deeper out of the money, if it offers me the 27-cent net credit. Because here now, going further out of the money to get the credit that you want, that you're comfortable with, even though you 25% of the time might not make that full 55-cent yield, you may be right 65 or 70% of the time, okay, making this, and then 10 or 15% getting it break even, and then only 15% realizing a loss. So I'd have to work out those numbers to see. But those are the three thoughts that come into mind. Is that number one, if I'm comfortable taking the expected 50% gain on this one, I'd probably also have to make sure that I don't take more than the 50% loss, okay, that this doesn't, the liquidation value doesn't go above 75 or 80 cents. Number two, I don't have the time personally to do this. It's great that you do, James, and I hope you're being successful. I'm sure you are. Otherwise, you wouldn't keep doing it. And number three, of course, is to get a better risk-reward ratio, I might drop it down for these 1-day, 2-day, 3-day trades, these Wednesday's expirations, to getting that 27-cent net credit or so, or 30-cent net credit, and maybe being successful more often than not, and seeing if that works as well. Yeah, and you like to sell the strike with a delta of 20 or less. Okay, good. So you would still sell that other position, but only, of course, if it matched your other credit that you were looking for. All right. Okay, so sorry about that, ladies and gentlemen. Okay, that's what we wanted to share with everyone. You know, we're just about 12 minutes past the hour, but if anyone does have any last-minute questions, I want to encourage you to go ahead and send those in. Okay. One of the great debates about selling weekly options, really managing weekly options, is it best to roll positions on expiration to the next week, or let it expire and buy back and enter the new trades on Monday? Okay. I am a proponent, okay, both are valid options. So what am I saying here? Is let's say that James's trade, for example, expires today. He entered it maybe a couple days ago, or he entered it today. But James on the SPX is expiring today. Now, if he wants to continue trading SPX, or we wanted to continue trading the LinkedIn position we saw as we get close to expiration, do we let it expire out of the money, or Friday at 3 o'clock, 4 o'clock, we can buy it back cheaply and then open the new position for the next Friday expiration, which is better? Well, both are valid approaches. As James mentioned, James added another comment here that his SPX trade, he's going to see a lot of time decay from 2 p.m. to 4 o'clock, okay? All right, so we can buy back and enter the trades. Both are valid approaches. The pro of rolling is that you get 2 extra days of time decay. So if I buy my bull putter bear call credit spread back at 3 o'clock or 3:30 Friday, and let's say this Friday, May 13th, and I sell a new spread that's out of the money for a new net credit for the May 20th expiration, barring any major events, of course, I get 2 extra days of time decay over Saturday and Sunday. So we open up Monday. If the stock's at the same price and volatility is the same, I'll see a decline in both options. I might be able to liquidate for a 20%, 30% gain of what I expected. So that's a pro of rolling early. The con of rolling is that we don't know what's going to happen over the weekend. Okay, so if Friday, May 13th, I close my position and I roll to a May 20th spread, come to find out Monday some new report came out. There was a flaw with the jobs growth report that came out a couple weeks ago, or something along those lines, manufacturing report, and the SPX, NDX, and so forth dropped down, let's say 1% or so, and it pulls all the market with it. Well, if I'm in a bull put spread, that might be very dangerous, because remember, I was probably only 1.5% out of the money when I opened the position to get the probability I wanted. Okay, so I feel personally, I do this personally in my account, but everyone has their own experience. I typically let my positions expire or close them on Friday, okay, and then I wait until Monday and maybe an hour after Monday opens to look for new positions for my weekly series on the broad-based indexes and ETFs. I just don't want to take the chance of some unexpected event happening over the weekend. Yes, I could get the 2 extra days of time decay, which is really relevant for these shorter-term trades, but at the same time, I don't want to take the chance of a sudden gap one direction or the other, a complete change in market sentiment from an unexpected event over the weekend that could cause a position to lose. So I typically let expire or buy back and then enter the new trades on Monday. That's just personal preference for me because I don't want to hold that position over the weekend if I'm only generating 20 or 30 cents or so. Now again, the keys to remember for those of you that are new, weekly options are no different than standard options. And we showed power options a little bit ago. And notice how there wasn't a tab for just opening weekly options, okay? You would still go to the same strategy. If you're looking for weekly options, well, you're still doing a strategy. You're doing bull puts using weekly options. You're doing bear calls using weekly options, okay? So there are no difference in standard options. You have the same exact rights and obligations that apply to any strategy, whether you're selling options or buying options or doing combinations as well. I encourage you to set your goals and allocation to a strategy first, okay? What I mean by that is don't force a trade just because weeklies are available. It has to be realistic for your needs, the money that you're allocating into the portfolio and into that strategy to make sure you're getting a net credit when you factor in commissions that matches what you'd want to see. Okay, it's just really important to do that. Doing covered calls. You know, I have investors who are trading covered calls and they look 1 to 2 strikes out of the money and they're comfortable gaining 10 or 15 cents on 300 or 400 shares per week and hoping it expires worthless. That's great, but it doesn't suit everyone. Okay, I prefer to go 3 or 4 weeks out in time and get 80 cents to $1, going 1 or 2 strikes out of the money if I'm doing a cover call. Really, I do that with my collar positions as well. One of the other cons of weekly options naturally is you have to watch more closely. We have tighter ranges for good premium. I mean, we're going less out of the money. You know, we still might be a good range, 2%, 1% out of the money for the net credit. We still might have a 70% probability because of the shorter time frame, but the losses or gains can come faster. So it requires a little bit more time to watch and manage the positions during the week because you're playing it closer to the vest to get a reasonable premium on the position. Okay? And again, not necessarily for everyone, but it's there. Now, Donna asked a question. May I access this recorded version for viewing, again, at my office before signing up for the subscription? Absolutely. I'm going to send everyone a link right now. This one, Donna, however, will probably not be available in the archives until maybe around 5 p.m. Eastern Time this afternoon. All right, so I'm sending everyone a link in the chat box there. It's poweropt.com/webinars.asp. And of course, let's just go there. I'll navigate there as well. For those of you on Power Options, if you go underneath the main Home tab and just click on Free Webinars, this page, Donna, you can access it anytime. You don't need an account. You don't need to be logged in to go to our Archive Webinars page. Today's presentation is going to replace the one from last year on weekly options, basics, further, and insight. So when you go to poweropt.com/webinars.asp, later on this afternoon around 5 p.m. Eastern, you'll see it listed at the top. The weekly options archive presentation will be there for you, and you'll be able to watch it at any time or any of our other presentations as well before you sign up for a subscription, before you even take the 14-day free trial as well. Chris says, I've heard that market makers know that, oh, sorry folks, hold on one second here. Oh, okay, sorry, that just glitched there for a second, Chris, my apologies. Just lost half the question. There it goes. Okay, so you've heard that market makers know over the weekend theta decays, so they make markets on Friday the same as Monday. Well, yeah, they do that. I can see that. This is the first time I've heard of it, so that's good insight, Chris. I appreciate that. And I can see that, but what that doesn't affect is I took a bull put credit spread, let's say, on Macy's. Okay, I don't know why I would do that. I'm not saying I would do that, but I took it on Macy's, let's say, on Friday, and they came out and said that their sales are going to be weaker. Some unexpected event happens, and all of a sudden it drops down. Market makers may keep the theta the same, but doesn't do me any good now if the stock's trading below my 2 strike prices for a quick unexpected event, which we could suffer at any time. Okay, that's the risk of spread trading. That's the risk of selling premium, is that it could happen from Wednesday to Thursday. It could happen from Monday to Tuesday in the pre or after market hours. Any sudden gap or gap up or gap down, depending on if we're bullish or bearish, could greatly affect the position. Okay, so yeah, you're right. I mean, that's great. It's good that you read that, and I'll have to take a look at that there to see if that's accurate over time, if they are doing that. And we'll take a look there. Ray mentioned, can I do options on futures with Power Options? No, unfortunately, Power Options right now just covers the U.S. stocks, indexes, and ETFs, the optional U.S. stocks, indexes, and ETFs. We do not have future screenings available in there as well. Okay. All right, and so Jerry, that sounds good, and if Jerry, that's great. I'm glad that position worked out for you there. Jerry was talking about a Mary put he has on Nike that worked out well for him because he had the hedge in place. Okay, so it looks like that's all the questions that I had come in. If I did miss a question, I do apologize. You can email it to me later at support@powerop.com. Remember, you can also reach us during the market hours by phone. You can call us at 302-992-7971. Or, of course, you can call us if you live inside the continental U.S. at 877-992-7971. Of course, there's contact links on the bottom of every Power Options page. Ladies and gentlemen, thank you for joining me for today's presentation. Just a reminder, of course, Friday at 4:30 p.m. Eastern Time, we have that open discussion, open presentation. If you go to that webinars page, I just said it, powerup.com/webinars.asp. You can click the link for Watch Live Webinars, and you'll be able to sign up for the open discussion, open forum presentation as well. Okay. Yeah, let's see here. Yeah, Chris says, assuming no price change, market makers would keep everything the same, no difference between Monday and Friday. In theory, yeah, if volatility stayed the same, there wasn't a change in volatility, wasn't a change in price, that sounds good. That'd be great, and that just gives us another reason to wait till Monday to trade the spread position at the open to make sure that there are no sudden movements. I agree. I agree completely. All right, well, ladies and gentlemen, thank you again. Take care. Have a fantastic week. We'll see you soon. Good night.